Welcome to The Explainer. Today we're diving into something that every business worries about, cash. It's the one asset that can literally grow legs and walk right out the door. So we're going to build a security blueprint, step by step, to protect your payday.
So if you run a business, how do you stop your cash from just vanishing? It's a question that, it probably keeps a lot of business owners up at night. And here's the thing, we're not talking about some elaborate heist with a masked robber. Nope. The real danger, more often than not, actually comes from inside.
One of the biggest and honestly sneakiest hidden risks is a type of fraud called cash lapping. So here's how it works. Imagine an employee takes a payment from, say, customer A, but instead of putting it in the system, they just pocket it. Now, later on, customer B pays their bill. The employee then uses customer B's money to cover customer A's account. You see what's happening? It's this constant shell game. A juggling act that can absolutely unravel a business from the inside out, unless you've got the right system in place to catch it.
Okay, so that sounds pretty scary, right? But the good news is there's a really elegant solution to this kind of risk. It's a core principle that's basically like a master key for financial security, and it's called segregation of duties.
And the principle behind it is stunningly simple. The idea is that no single person should ever have control over a transaction from start to finish. Just think about it this way. The person who physically touches the cash should never be the same person who updates the company's books. By splitting those two jobs, you literally build an automatic check and balance right into your process. It's brilliant, really.
So how does this work in practice? Well, you can think of it like creating a security team with 4 very specific, very separate jobs. You've got the custodian, their only job is to protect the physical cash. Then there's the recorder, who updates the books. The authorizer is the one who has to approve any changes or adjustments, and finally, the reconciler comes in as an independent party to make sure everyone's story adds up. See? No single person holds all the keys to the kingdom.
All right, let's really see how this works in action. To get a clear picture, we're going to follow the money down 2 parallel tracks. First up, the journey of the actual physical cash.
Okay, so this is the custodian's role. Their mission is 100% physical. Let's say it's a cashier. They get the cash or checks from a customer. First thing they do is secure it. Stamp those checks for deposit only and create a detailed list of every single payment. Then, all that money gets deposited at the bank right away. And here's the crucial part. They send a copy of that deposit info over to accounting. They touch the money, but they never touch the main company books.
And this right here is the heart of the whole system. You've got the physical asset, the cash and checks, handled by the custodian over on one side. Their world is all about bank deposits. On the other side, you've got the records, the information about that money, and that's handled by the recorder. It's their job to deal with customer accounts. It's this critical separation, keeping these two streams completely apart, that makes the whole process so secure.
Okay, so we followed the physical money. Now let's jump over to that second path and follow the information's journey.
This is where the recorder, our accounts receivable or AR clerk, comes in. They get that payment list sent over from the cashier, and their only job is to update the records. They go into the accounting system, match each payment to the right customer invoice, and mark it as paid. And again, notice what they're not doing. They never, ever have access to the actual cash or checks. They're only working with the data.
And this is kind of the aha moment. This is when the transaction becomes official in the company's main financial system, the general ledger. This simple little journal entry says 2 very important things. Debit cash means, hey, our bank account just went up, and credit accounts receivable means that customer doesn't owe us that money anymore. It's paid.
Okay, so we have 2 separate paths. But how do we know for sure that everything went perfectly on both sides? How do we prove that there weren't any mistakes or, any funny business? Well, that's where our final, totally independent roles come into play. This brings us to our first big independent check. So what happens if a customer takes a discount they weren't supposed to? Or maybe there's some other small discrepancy. You can't just let the cashier or the AR clerk decide what to do. You need one person, an authorizer, maybe a credit manager, who is completely separate from both handling the cash and updating the daily records. Their job is to approve those kinds of exceptions. They are a critical, independent checkpoint.
And that brings us to the grand finale, the ultimate verification step, the bank reconciliation. This is the big one. And the key here is that it has to be done by a reconciler, someone who is completely 100% independent from everyone else we've talked about so far. So, what does the reconciler do? Well,
Their job is basically to make sure everyone's story is the same. They take the deposit list from the cashier, they look at the records that the AR clerk updated, and they compare it all against the official statement from the bank. If all three of those documents tell the exact same story, down to the penny, then you know the system is working and secure. If they don't match, well, that's when the alarm bells go off and an investigation starts immediately.
So, let's step back. Why go through all this trouble? Why create all these separate roles? Well, because this isn't just about following some boring accounting rules. It's literally about building a fortress around your company's finances.
Let's boil all this down into some key takeaways for your business. First, the absolute best practice: use a bank lockbox. That way, customer payments go directly to the bank and completely bypass your office. You remove the risk entirely. Now, what if you're a small business and you just can't separate all these duties? Well, in that case, the owner has to be the final check. The owner personally needs to review the bank statements and reconciliations, no exceptions. And the bottom line here is that this whole system is designed specifically to stop fraud like cash slapping in its tracks. It's not just theory, it's a practical defense system.
So, that leaves us with one final thought, a question for you to take away. Now that you've seen the blueprint, where is the single biggest weakness in your own company's cash handling process? Really think about it, because if you can find that weak spot, you've also found the key to protecting your payday. Thanks for watching.